What's happening, everybody? It's your boy Creative. Go ahead, say it with me. We are back at it again to do what? To create something great. Now, today I'm super excited what I have planned for y'all today. We're going to be dropping another episode in our Creative View series. Today, we're going to be discussing VIX, and VIX is the volatility index. VIX allows us to be able to gauge how, quote unquote, it is the fear index, right? Being able to see how volatile the market is, right? What the market expects to happen in the next 30 days. So today we're going to be going over how VIX works, how it's calculated, looking at it at historical context, and also looking at it live. So if you haven't already, I need you to go ahead and like and subscribe. So let's go ahead and jump into this thing. So what is VIX? Right, so that's going to be lesson one. We're going to have 6 lessons here, and after each lesson it's going to accompany a quiz. So I do need you to follow along and making sure that you're getting what you're picking up, what I'm throwing down. You got it? Beautiful. So VIX, and each lesson is going to have a word bank, a simplified version of it, technical definitions, right? So we're going to be thoroughly breaking this down so we can proper understand this. All right, so what is VIX? VIX is the market fear index. When VIX is high, that lets us know that the market is scared, right? Individuals are in panic mode, right? This is when they want to offload shares. This is when you're seeing a lot of selling pressure, right? You're maybe also going to see this, and not always the case, right? But there's a good majority of the time you're going to be seeing this in a bearish condition. So what does bearish mean? Bearish means is that the underlying market is in a downward trend, right? So it's going down sometimes when VIX is high. Now I've also seen when VIX is high, we're in a bullish trend. So that's why I say just put that little caveat there. It's not always the case when VIX is high, we're in a bearish trend, but a good majority of the time, right? And when VIX is low, we're calm, cool, and collected. We're not expecting anything crazy within these next 30 days, right? VIX is kind of cool, not that much things going on. So if you want to pop over to Trading View real quick, and I'm looking at VIX on the 1-minute chart, and that lets me know, and each one of these candlesticks represents 1 minute of action between the buyers and the sellers, right? So the green one is going to be the buyers or the bulls, and the red one is going to be the sellers or the bear, right? So currently it is February 9th, 2026, whenever you're watching this. Currently VIX is at 17. So it's not elevate. It's a bit elevated for me, right? Some would say that as normal, but for me in my house, that's a bit elevated, right? It's at 1507. I still consider that a bit elevated, and you're going to see how we're going to adjust out our algos accordingly, because majority of our algo trading bots, they use VIX to be able to size their positions, right? And that's going to make sense to you in a bit here. So let's go back to our lesson. Volatility is how wild the prices will jump around. It's a roller coaster, right? Equals high, right? So a roller coaster is going up and down, right? So that's what volatility allows us to be able to gauge. S&P 500 is the biggest 500, the top 500 companies within the New York Stock Exchange. Forward looking is when we're predicting the future and not looking at the past. OTM options, or out of the money options, is we're going to be betting on a big move to happen, right? Implied volatility, or implied vol, that vol is volatility, is fear baked into the option prices. This is what the trader expects. And then we're going to have the tail risk. The tail risk are rare, but these are extreme events, and these are the long shot disasters, right? So a simple version, imagine VIX as the fear meter for the stock market. Low numbers between 12 and 15. Everybody's chill, cool, calm, and collected. Nobody's really pressed about anything, right? Everybody's trading as normal. VIX has just jumped a little bit, and I may be doing this because the market is still open. So y'all saw when we started, VIX was at 1709. VIX has now jumped a bit to 1714, right? This is going to make sense as we get to this, right? So between 15 and 20, normal, nothing crazy. But again, I'm kind of side-eyeing the market, just trying to figure out, okay, what's really going on. When I say the market, right, what I'm talking about, because VIX is based off of the S&P 500. The S&P 500 are the top 500 companies within the New York Stock Exchange, right? So VIX and the S&P 500 has a inverse relationship. What do I mean by that? Not always the time, but a good 95% of the time, they're going to have an inverse relationship, right? So if we're going to pop back over to Trading View, I already have VIX open, but let me go pull up S&P 500. I'm using Trading View, super simp, and if it's free, it's for me. So I told you it has that inverse relationship, but it's not always the case, right? So we're seeing SPY right now at 695.17, but we're seeing VIX pop up a little. Oh, okay, just dropped. Never mind. VIX is popping a little bit, right? So we're seeing both of them kind of going in the green, but VIX has been in the green, and she's been gone that way all morning or all day. Again, today's February 9th. So SPY is a bit on the bearish decline right now. So you see that a bit of that inverse relationship, right? So VIX is just greening, and then SPY is on that bearish decline. So we have a bull run that is happening right now as you're watching this, and we're having SPY a bit on a bearish decline right now. I mean, the buyers are trying to fight back, but it's to no avail. How do you know that? Is because we have dojis forming, right? We even have hammers forming. And how do I know that there's rejection? Okay, that's a doji. These wicks are populating. So even though the buyers are in control, never mind, the sellers are just in clear command and control of the market right now. And that usually what's happened within the last couple of minutes of the market. So let's go back over to our lesson. And in between 25 and 30, this was when people are starting to get nervous, right? I started to get nervous around 17-20, right? I'm not going to hold you. I'm not waiting to 25. Right, we adjust accordingly, like around 17, 18, 20. Reason being so is because that's a bit elevated. Now, normally VIX sits around between 10, 13, 14. Sometimes it'll pop around 14, 16, right? But once it hits 17, it's like, okay, what are we doing? What's going on? What is the market expecting? Right? So that's why I want to be able just to keep your eyes peeled at the 60. Okay, look at that. VIX is on, when I say a bullish run, fam, a bullish run, and it's not playing at all. Have you seen the red candle? Nope. So what is this called? A bullish run. It's crazy. All right, that's what I'm saying. 17, my eyes are peeled. I don't wait to 25, right? But normally everybody has a different school of thought. For me in my house, it's 17. Now between 25 and 30, people are going to start getting nervous, right? They want to try to figure out, okay, what's going on? Should we start adjusting our portfolios accordingly? Because the market is expecting a big move, right? And plus 40. Yes, I've seen VIX hit 60 last year, August. VIX hit 60, and we're going to see that throughout these lessons here, but VIX did hit 60, fam. So when you see VIX at plus 40, you're in extreme panic mode. We're expecting a run either way, right? That run could be a bullish run or a bearish run, but like adjust accordingly, right? So that's why VIX matters. So VIX tells you how scared investors are right now, and right now with VIX popping to 17, I think people are starting to get a bit nervous, right? I don't know if they're holding their water right now, because even like the VIX is still holding that resistance line. I haven't seen it drop yet. You see this big body candle right here? Do you see any rejection? No. Whereas SPY right now, that that bearish decline is definitely happening. So you see when it's having a bull run, when it's having a bear run. I mean, yeah, but again, rejection. Bit of a doji. Okay, you just seen it here. So that bear run is definitely evident there. Even though it ended up closing green, a bull, it's still a doji. And look what happened. So let's go back. So technical definition, the VIX, it came from the CBOE. CBOE is the Chicago Board of Option Exchange. So you may see that later. What does CBOE stand for? Is the Chicago Board of Option Exchange, Volatility Index. It measures how much the market expects the price to jump over the next 30 days. Memory trick, VIX equals the market fear gauge. High VIX equals high fear. So here's some key facts about VIX. VIX is a non-tradable asset. It is one of those technical indicators that you always hear people are using. Oh, these are my technical indicators that I use in order to understand what the market is doing. VIX is that, right? VIX is your technical indicator that you're going to use in order to figure out what's going on. And bruh, like, I didn't plan this. I don't run the market. This is just kind of serendipitous how this is working this way, that VIX is on a bull run, and we get to see this live. Like, it is breaking stride right now that it just broke the resistance line. This red line is the resistance line. How do you know it's resistance? Because I'm looking at the Bollinger Bands. This red line is going to be your overbought line. This blue line is going to be your moving average, and this green line is going to be your panic oversold line. So you see, where's SPY hanging out? Panic mode, right? Where's VIX hanging out? Oh man, FOMO mode. Everybody wants to be able to get in, but again, VIX is not tradable, right? VIX is one of those technical indicators, right? It's an index like the Dow. Forward looking, it measures expected volatility derived from options, right? And one option contract equals 100 shares of the underlying security. But more on this a bit later. And it uses the S&P 500 option prices. And the S&P 500 is the top 500 companies within the New York Stock Exchange. And annualize, subtract V20, excuse me. Annualized VIX of 20 equals 1.25 daily expected moves. Now that move could be, damn, bruv. Look at this, bruv. Have y'all seen a bear yet? Nope. When I say this is on a bull run and SPY better watch out, like definitely watch out. This is crazy, and it's about to, and it's that resistance line is where it's at right now. Right, and SPY is just hugging that oversold line, the panic mode line, right? So I like to call this the panic line, and this is the FOMO line, right? So this panic line is where SPY is hanging out, and the FOMO line is where VIX is hanging out. And that's kind of a bad thing if you're trading in the market right now, right? Kind of crazy. Where was I? So, okay, beautiful. So right now, again, this is a bit delayed, but we just saw VIX when we started. VIX was at 1705. Right now, VIX is at 1725. So it just jumped 20 cents, right, or 20 bips, right? And that's crazy. And the 52-week high is 60.13. This happened back in August of 25, and the 52-week low was 13.38. This happened back in December, I believe. Again, this is normally where VIX is hanging out. VIX is normally hanging around between like 12, 13. Okay, look at y'all. First bear appeared. I had to show this. If the market is open, I want to be able to take advantage of it so y'all can see it. Nope, you still on the little decline. They took over, so let's see if like it's actually going to happen. Oh, excuse me. And this happened December of 25, I believe. So a visual in order for you to be able to understand it. So between 10 and 15, VIX is chilling. There's nothing really for you to worry about. Everything is normal. Between 20 and 25, really between 17 and 25, that's when, for me in my house, that's when it's elevated. That's when my face is right here. I'm trying to figure out, okay, what's going on? What's happening in the market? Is there something? Look, y'all, look. Oh shit. Excuse me. It went bear bull because you remember the market is still open. It went green. Now it just went bear. It just went bull. Excuse me, went bear. What am I saying? Now VIX between 30 and 35. This is when it's elevated high, right? And then anything plus over 40. Okay, you watch out. What's going on, right? This is when you're in panic mode. So right now VIX is. I mean, I'm kind of chilling. I'm kind of side eyeing it right now. Okay, look. I say bear run, bruv. Bear run. Now look at this. Straight shot. Where are you hanging out? Panic mode. Where are you hanging out? FOMO mode. That's crazy. Straight shot, fam. I mean, right now it's trying to find its way back to its average, but I think VIX is probably going to close like around 17. I'm going to say 1725, maybe even 1730. I think it's going to close. We have about 12 minutes, but I should be done well before that. But again, VIX is kind of going crazy right now, and I think that's prudent for us to be able to talk about. So what the VIX numbers really mean: VIX of 20, the market expects 1.25 daily moves in S&P 500, and that daily move could be a bearish run, and that daily move could be a bull run, right? Normally, it's a negative correlation. When you see VIX is popping, SPY is going to be down, as we did see evident here, right? We're going back and forth, and we see that VIX is on that cool bear run. It's cool. I keep getting that. I'm sorry. I know what I'm talking about. Right, I just keep confusing it too. My fault. I've only been doing this this streaming thing like for the past like 4 months, so there's a few things I'm going to get confused. So my fault. Right, they're going on a bull run. excuse me, and then you have SPY right here just hanging out in the little panic mode, right? Seller pressure mode. Even though it's trying to find its sea legs again. But okay, look. But let's see if it stays. Let's see if it stays. That's the thing to understand. Okay, VIX of 20. Market expects 1.25 daily moves. That could be a bear or bull. VIX of 30, 1.9. VIX of 40, 1.25. Or excuse me, 2.5. And then VIX of 80, which is kind of crazy, but it has happened, is 5%. And that's huge, right? This is we're in definitely a crisis mode. And that could be a bear or bull, right? Normally it is a bear, right? Normally it is that inverse relationship, right? As we saw evident in what we've been doing. So next thing, how is VIX calculated? Let's go under the microscope, right, to figure out how VIX is calculated. So think of it like polling thousands of option traders. We gather out of the money OTM, out of the money options for the S&P 500. We have out of the money puts, and puts is we are bearish on the market. We think the market is going to go down, so we bet it's going to crash, right? And calls, we are bullish on the market. We think that the market is going to go up, so we're going to bet it's going to rocket. This captures the tail risk. Remember, we talked about tail risk, right? Tail risk is a rare event. These are extreme events. This is the long shot disaster, right? So being able to take OTM puts plus OTM calls allows us to be able to capture the tail risk expectation. Then we weigh them by the strike price, and the strike price is the price that we think the underlying stock will go, option contract will go to. More weight on options that are further from the current price. That's where we have OTM options, right? This captures the fear of the big moves, not just small wiggles, and combine them into one number and annualize it. Boom, that's VIX. Key is that VIX isn't one option. It is a consensus of thousands of traders betting real money, right? That's why it's called implied volatility. It's implied by what people are willing to pay for the protection, right? When you buy puts, you normally are buying insurance. When you buy calls, you normally are buying I would say lottery tickets. You normally are buying for the momentum that is going to go on a bullish run, right? All right, so I told you, let's go ahead and go to our quiz now. So what does VIX actually measure, right? VIX measures how much the S&P 500 moved yesterday. That's interesting. The market expected volatility over the next 30 days. I think I heard that before. Or does it measure the fear level of the individual traders? Maybe, right? But you have to be able to get more context. This is one of those good or better answers, right? This is a good answer, but this is the better answer here. Beautiful. Why? VIX is forward looking. It measures what the market expects to happen, not just what already happened, right? It's already derived from the option prices. These are things that have already happened. And VIX right now, fam. I just want to bring this in. VIX right now is at, remember I told you, mine is at 1725, I think, where VIX is going to close. VIX right now is at 1738. We started, VIX was at 1705. People are going kind of crazy right now. Yes, we're seeing some bears pop in, but the majority of it, and where's SPY? SPY still hanging out at the panic line, right? Where's VIX hanging out at the FOMO line, right? Still a little upward trend, but the bears are stepping back in. Can you buy VIX directly like a stock? I think we talked about that. Yes. Just enter VIX into your brokerage. You're probably going to crash your app. No. VIX is an index. You need futures or ETFs. Or C, only can trade special volatility exchanges. There's no such thing, right? So it is going to be B just by process of elimination. Why? VIX is an index. It's not a tradable asset. You can buy VIX directly. You need VIX futures or options like VXX or UVXY in order to trade VIX. So VIX is at 30, right? What does this roughly mean for the daily SPY moves, right? So VIX at 30, right? This means that the S&P 500 or SPY will move exactly 30 points. That's interesting. I don't know if that's the case. The market expects a move of approximately 1.9% in the daily moves. or 30% of traders are bearish. I wish it was just easy as that. You just look at it and be like, oh, they're bearish, right? So just by process of elimination, we can go ahead and go with B. All right, beautiful. So let's go ahead and go to our next lesson. So VIX futures, right? So we're talking about actually being able to purchase VIX, right? And term structure. So a future is a promise to buy something later at today's price. So whenever you hear of future contracts, right? What is a future contract? A future contract is a promise to buy something later at today's price, right? Contango is a future price is greater than today's price. This is the normal market state, right? Normal market state is at Contango, right? Backwardation, right, is today's price is greater than the futures price, right? This is when we're in panic mode. Why? Is because, right, today's price is greater than futures price. We're in backwardation. We're in panic mode. And then we have term structure. Term structure is the chart showing prices for different future dates. And then we have roll. Roll is the swapping expiring contracts for a new one, like renewing, right? Bam. I think we may even see VIX cross 18. VIX is at 1750. SPY is still hanging out at that panic line. VIX is hanging out. It's like everybody going to the club, right? They're excited, they jump, they hype, they want to be able to keep going. This is everybody trying to leave the parking lot after a big event, right? They're like, bro, I'm really caught in this tailwind, right? This is just your panic line, right? All right, let's keep going. I think we're really getting the point here. And VIX is really just popping. It's at 1748, fam. All right, so in simple terms, think of VIX futures like a concert ticket. Contango, right? Normal market conditions. The concert tickets are, tickets are for 3 months away, cost more than tickets that are for tonight. It makes sense because minus time equals more risk. More time equals more risk, right? And then backwardation, we're in panic world. Everybody wants the ticket tonight for tonight's show because the band might break up. Today's prices is greater than the future prices. That's why we're in backwardation. We're in panic mode. So does that make sense? Right? All right, beautiful. So technical definitions is that VIX futures are promised to buy VIX at a future date. The term structure shows the prices for different future months. Memory trick, term structure equals the price schedule across time. So we have two different type of term structures, and we've been trying to break this down over the course of time, right? We have our Contango term structure. This is normal 80% of the time. Futures equals is greater than the spot, right? And your spot is just today's price. Whenever you see spot price, that's just today's price, the price of the underlying asset, right? Equals the market. Oh, I thought VIX is at 1747. Market calm, right? Everybody expects volatility later. But if we're in backwardation, we're in fear 20% of the time. This happens 20% of the time. The future prices are less than the spot prices. Market is panicking now and expects calm later. So let's look at a live view. So right now, the structure is Contango. Everything is normal. But again, this is Contango with a little bit of a elevated eyebrow raise, right? If you're the rock, the people says, right? A little bit of an eyebrow raise because where we are right now, right? I think, I don't know, right? I'm not an analyst. I'm not a predictor. If you do see financial advice, please make sure you talk to a certified financial planner, those that are licensed in order to assist you with your financial questions. This is merely educational. I think, right, the market is setting itself up for a little bit of a downward turn. I don't know how long it's going to last, right? But I don't know. Things are just looking a bit hawkish. There we go. If you were watching that CPI Fed video and then EPA video, you understand what that hawkish term means, bruh. All right, let's keep going. So why this matters for trading: Contango equals VXX or UVXY. Believe these these ETFs hold futures that decay as they roll forward. And remember, when we roll forward, now we talk about the renew yet. Oh yeah, rolling is renewing, right? So we're swapping our contracts, expiring contracts, for new one This is like renewing. So whenever you see that term rolling, right, for option contracts, is meaning that you're swapping your expiring contracts for new ones today. All right. Typical loss is about 5% per month in a calm market. And backwardation, we have a tailwind. Rolling futures actually gains during fear events. This is when VIX spike can be 50 to 100% in days, right? And we're seeing a bit of a little bit of a spike, a little 40-point spike, right? Because it went from 1705, it's like 38. Nope. 1705, and it's at 1744, right? So that would have been 37, right? And it's doing its thing right now. So let's go ahead and go to our quiz. VIX spot is at 18, right? The front month future is at 21. So spot is the price and the front month future is at 21. So 18 is that greater than 21, right? So we're in our Contango, right? Just to make sure, because these are new terms, so I want to make sure that we understand this. Is our spot price, hold on, where it is. All right, here it is. Our future price is greater than our spot price. This is market conditions, our calm. This is expected volatility later. So let's go to our question. Our future price is 21. Is 21 greater than 18? Yes. If 21 is greater than 18, then we are in Contango. We are normal market conditions. Beautiful. Why? 21 is greater than 18 equals Contango, right? So the future is greater than the spot. Perfect. 80% of the time, this is what happened. Market is calm. We expect volatility later. Oh, VIX is on a little backward slide right now. In Contango, what happens to VXX over time? It goes up because volatility is expected. Not really. Volatility is expected later, but like how much later? That's one of those a good, but can we find a better answer, right? It bleeds value due to the negative roll yield because you have to be able to keep rolling it over. So that sounds like a better answer. It stays flat, tracking VIX perfectly. Not really. So let's go ahead and go with our better answer. Why? Because VXX holds futures. There are, that are 50 more expensive than the spot price, right? Spot is just the underlying price of the asset itself, so underlying price of SPY. As they approach expiration, they decay towards spot. This roll costs 5 to 10% monthly because you have to be able to renew it, right? And what does backwardation typically occur during a calm bullish market? Not really. Remember, what is backwardation? Backwardation is when the spot price or the current price is greater than the future price. So if the current price is greater than the future price, this is during fear and crisis events like COVID or 08, or every Friday at market close. That would be some shit, wouldn't it? So just by process of elimination, we can go with B. All right, beautiful. Let's go ahead and go to our next lesson. We're making great time here. So VIX versus the S&P 500, the inverse relationship, what we've been talking about, right, this entire time. So correlation, when two things move together, correlation and causation. If you went to, I didn't want to burp in your ear. If you've taken any political science class, you've like heard that term before, causation and correlation, right? Just because something is correlated doesn't mean it caused it, right? Okay, beautiful. So correlation is when two things move together or in opposite direction. Inverse is the opposite. One goes up, the other one goes down. SPY is the S&P 500. It tracks the top 500 companies within the New York Stock Exchange. And then hedge is protection against losses, right? So portfolio insurance, you normally hedge while buying puts. All right, so VIX and SPY are like a seesaw. When SPY goes up, we normally see VIX go down. So when the stock price goes up, people are happy, fear goes down. But when the stock crashes, people panic and then fear spikes. So technical definition, VIX and the S&P 500 move in opposite directions. The correlation is approximately negative 0.8, right? Correlation, stock falls, the fear rises, and the stock rallies, fear fades. Memory trick, if SPY is down, VIX is up. But if SPY is up, VIX is down. Remember, we've been talking about that all day before we even came to this lesson. So we've been seeing, I mean, VIX right now is on a bit of the a little bearish decline right now. Market is about to close in about 16 minutes. And we see SPY on its bullish run right now, even though you see, okay, just made my point forward. SPY just moved its way back to its average, and right now it's trying to find its way to the party. So it's tired of being stuck in the line, and it's trying to find its way to a party, right? So let's see if it can find its way there, because it's looking like SPY just had a crazy day today. You see this squeeze that's happened right here? This squeeze resulted in this downward decline. Squeezes don't always happen that way. Squeezes like right here, right? We see a squeeze that, damn, SPY opened. Y'all see this? It's massive. That is massive. A squeeze, right? And then we see a little downward decline. I'm trying to show y'all a squeeze, right? A little bit of a squeeze. Then we have a little upward decline. So squeezes doesn't always mean negative, right? We can have a squeeze that can be a little bit of a positive. So we have a bit of a squeeze here, right? And that squeeze just went to a little bit of a bearish decline. Now SPY is trying to find its way back to the club. And we have VIX right now. I mean, it's on a bearish decline, right? I'm not going to hold you. It's finding its way to the panic line, right? While SPY is trying to find its way to the oversold line. So we see that inverse relationship live in play, right? So why inverse? VIX is derived from the S&P 500 options. When the stock drops, traders buy puts for protection. Why are they buying puts for protection? Because they're trying to hedge their bets. Increased put demand equals higher option prices. VIX go up, right? So you can deduce that when VIX is popping, right, you're seeing increased selling, increased hedging. Increased hedging mean increased individuals that are buying puts, right? Puts on SPY, thinking that SPY is going to crash. Interesting. When the stock rallies, there's less fear, and then VIX compresses, right? So we're going to load our historical data comparison. So we have VIX and then SPY, 2020. So this is COVID, right? SPY was at 309. VIX was at 33. SPY, and this is daily, 336, right? 313, 32. So y'all can see that inverse relationship, another historical point of view, right? SPY is jumping, 41, 297. Then SPY went to 75. SPY went to 75. That's 10 days later. 10 days later, SPY went to 75, and then, excuse me. VIX went to 75, and then SPY crashed to 248. That's crazy. 10 days later after COVID, right? 75, 248. Then we have 82. I told you the 80s happened 14 days later. So 2 weeks later, right? VIX spiked to 82. SPY crashed to 240. Then it found 75 again. So just in a matter of 17 days, SPY crashed. VIX exploded. Explodes the inverse peaked 85 back in March 18th, 2020. This was an all-time high. And then VIX dropped from 337 to 218, a 35% drop. The VIX spiked from 14 to 85, 507%. That is mad. So key insights here is when VIX spikes fast, the fear hits suddenly, the elevator down, right? So you go down in the elevator a lot quicker than you go up, right? When fades slow, VIX fades slowly, market returns to calm gradually, like taking the stairs up. Why? Because long positions are hard to time. Short VIX is profitable but dangerous, right? And we'll limit more shorting on positions a little bit later. And VIX mean reverts, but it can remain elevated for weeks. What is mean reversion? Is when it goes back to its average. When you see mean revert, is meaning that it's going to go back to its average. So SPY drops 3% in 1 day. What typically happens to VIX? VIX drops 2. If you say that, you haven't been listening. VIX spikes significantly, the inverse correlation. VIX stays flat because of its forward looking, right? So we can eliminate by process of elimination A and C, and we're going to go with B. I'll make this comment later. VIX spiked from 20 to 50 in a week. What is the typical return to normal? Fast crash back down in days? No, if you've been listening, right? It can spike to 50, it can spike 30 points, right, in a week, but it's normally going to be a slow grind back down. A slow grind lower over weeks and months. It stays elevated permanently. Why would it do that? So just simply by process of elimination, we can eliminate A and C, and then we can go ahead and put B. During COVID crash, March of 2020, VIX hit an all-time high, right? Yes, it did hit 35. Yes, it did hit 55 with that all-time high, right, of 85, which is crazy, fam. All right, now let's go to our fourth lesson. Our fourth lesson is VIX, ETFs, and ETNs. So an ETF is an exchange traded fund. This is a basket of stuff that trades like the stock, right? An S&P 500 is an ETF that has the top 500 companies within the New York Stock Exchange. QQQ is an ETF that has the top 100 companies within the NASDAQ. The DIA, right, is an ETF that trades the top 2,000 small cap companies. So as you can see, you can have multiple different ETFs. What we're focused on today is the VIX ETF or ETN. An ETN is an exchange traded note. It's like an ETF, but it is a bank loan. All right. Decay is losing value over time. This is an ice cream melting. And rolling cost is the money lost from swapping contracts. This is the VXX fee. Leverage is amplified 2 times equals double moves either up or down. So in a simple version, VXS is like an ice cream melting cone on a hot day. Day 1, full scoop, we at $100. Day 30, it's melting, it's at 90. Day 90, it's melted a little bit more, now it's at 70. So 90 days in, you already lost $30. That's crazy, right? Day 365 is just a puddle. You only at $20. Why? Every month, VXX must swap old contracts for new ones. That costs more. The swap fee eats your money. VXX lost 95% over 5 years. Not a buy and hold, right? VXX, you definitely don't buy and hold VXX. VXX, I mean, you can trade it, but again, you better know what the hell you're doing when trading that. That's futures. So VXX ETFs are VIX ETFs, excuse me, is VXX or UVXY. It holds VIX futures, not VIX spot. VIX futures is allowing you to buy something to tomorrow based on today's prices, and VIX spot prices allow you to buy something today based on today's prices, based on tomorrow's expectations, right? So the monthly roll cost caused them to lose value 50 to 80% per year. Memory trick, VXX over UVXY is a melting ice cream, not a savings account. Common VIX products, so we have the VXX, which is the iPath, the short-term VIX futures, the ETN, the exchange traded notes. UVXY is ProShares 1.5 times the VIX short-term leverage. Then we have SVXY, which is shorting VIX equals profits. IVXY is short-term future ETFs. And then IVXM, which is VIX midterm future ETF, slow decay. So live look at the prices, right? We have VXX at 26, but VIX is trading right now at 1728. So I'll let you do the math there, right? Then we have UVXY and the others that are bringing them in. And we have a live look at VXX historically, right? So we saw its peak 50. That's for COVID, bro. COVID. That don't make no sense. COVID. COVID just a lot of shit don't make no sense. All right, so Contango. Remember, Contango is today. The market is calm, cool, and collect. With backwardation, is the market is a little bit more panicky, right? So VXX holds front month VIX futures. And Contango, the front month is less than the next month, right? Contango, front month is less than the next month. You may see that again. As expiration nears, VXX must roll to the next month, and that's called the roll fee. So that's what eats up most of your profits if you're doing the monthly buy and hold, which is crazy. selling cheap expiring futures and buying new expensive ones. This roll cost is about 5 to 10% per month, compounds to 50 to 80% of annual decay. You just throw money to the wind. Crazy. So why do VXX? Okay, VIX right now is at 1738. I put a wager, and this is a little bit of prediction market, but not really, but a little bit, right? So I said VIX was going to be at 1725 when it closed. Right now it's at 1738. So let's see. If I'm wrong, that's okay too. So why do VXX and UVXY lose value over time? Management fees are extremely high. That's one of those, right? It is an ETF. It is exchange traded fund. So somebody is managing it, right? The Contango roll cost from the future decays. That sounds like we may have heard it again. Market manipulation by hedge funds. Conversation for another day. All right. You buy $10,000 worth of VXX in a calm market. Why the hell would you do that? But hey, you put 10K in VXX in a calm market. 1 year later, it's likely worth, right, 2 to 5,000. Massive decay just from rolling cost. And we see we have a different answer. That is not B. I know you're trying to follow it. Best time to hold VXX or UVXY when the market is calm, VIX is low? Probably not. During fear spikes when VIX is spiking, like right now, maybe, right? But again, this is not financial advice. If you do seek financial advice, please make sure you talk to a certified financial planner. Those that are licensed in order to assist you with your questions. This is merely educational. Maybe during a little fear spike, hold forever as a hedge. Probably don't want to do that. So as a process of elimination, we can go with B. All right, so our lesson 5, we have one more after this, and we're going to be wrapping it up. So terms to know is going to be mean reversion when things go back to normal. Extreme doesn't last. We're going to have a spike, a sudden sharp jump. This is a heart monitor during a scare. Premium is going to be the extra cost. Options are pricier when fear is high, and VIX right now is at 1736, so it is jumping. Insurance is pay a little now to protect against big moves. Implied vol, right, is the market expectations baked into the option prices. Realized volatility is what actually happens measured after the fact. And we have volume risk premium is gap between the expected and the actual. Fear tax. Let me call that slippage, but fear tax. So VIX is a weather reporter for stocks, right? VIX between 12 and 17, clear skies, smooth sailing. VIX between, for me, is really like VIX between 12, like 10, and maybe 14, clear skies, cool sailing. Between like your 15 and your 22, some clouds, nothing serious, but your eyebrow better be raised and trying to figure out what the hell is going on. VIX between 20 and 25, storms are brewing, you better be careful. VIX between 25 and 30. These are heavy rain days, or some are calling an OVO day. If you know, you know. Take shelter, and VIX at plus 40, a tornado warning, right? Dorothy is on the rise. Like, look for Dorothy in her shoes at that point, right? Crisis mode. What to know and when to be careful. Use it to know when to be careful, not to get rich fast. So technical definition, VIX is best used as a market indicator and a hedging tool. Read the fear levels, protect your portfolio, don't gamble. Memory trick, VIX is the weather report, not the lottery ticket. So 3 main use cases, right, as a market indicator. And we went over live how to be able to use VIX as a market indicator, right? Most of our algos has VIX as a portfolio hedge, right? So when VIX is jumping right now, we're probably going to bet a little bit less into the market, whereas VIX is low, we're probably going to put a little bit more into the market, right? So that's how you can use it as a portfolio hedge and as mean reversion trades. This is a little bit different, right? A little different, but you can still do it, right? Advanced strategy, we're selling VIX when it's extremely high, expecting that it's going to drop down, and we're going to buy VIX when it's extremely low, expecting that it's going to bounce. Requires careful, and you better know what the hell you're doing. Risk management, or CYA. So volatility risk premium, or VRP, VIX is like a weather forecast that exaggerates. Forecast says 80% chance of rain. Reality, it only rains 60% of the time. The gap, the 20% overestimates, is the risk premium. Implied volatility is what traders expect to happen. Realized volatility is what actually happens. So VRP equals, you may see this again, so probably keep this in mind. VRP equals the implied volatility minus the realized volatility, and it's usually positive. So historically, VIX overestimates realized volatility by 2 to 4 points. VIX says 20, the actual moves are closer to 16 to 18. Why does this matter? For option sellers, right, individuals that are selling puts, right, collecting premium, your VRP is your edge, right? You collect the overpriced premiums like being the insurance company. Profit most of the time, but one hurricane can wreck you when everybody's calling in that premium, right? So that's why you better cover your ass. Oh, look. VIX closed. So I was a bit wrong. VIX closed at 1758, so a lot higher than what I estimated. I thought VIX was going to go to 1725, but VIX closed at 17. It's at 1745 right now. So let's say VIX closed at 1745, which is still kind of high. For option buyers, oh, let's look at where SPY closed. Where did SPY close? Damn. Y'all see that? Bruh, SPY closed at 693.95. That's crazy. All that selling pressure. What's that? That's selling pressure. That's crazy, bro. That's crazy. I'm glad y'all got to see that live though. So for option buyers, you are paying the fear tax and minus overpaying for safety. Is worth it when you need protection, portfolio hedge, right? Not worth it for speculation, gambling, right? Decay eats you alive. Danger, VRP is positive 85% of the time, but the other 15% of the time, VIX underestimates and the spike crushes the sellers, right? So current market read is at VIX 1732. That's when we got here, but VIX closed at 1746. Kind of crazy, right? And that's been a consistent theme here. Normal, average, but kind of eye up, right? Contango vibes right now because again, what is Contango? Future greater than spot, right? Cool, calm and collected. What if the spot is greater than future? Yo, what's going on? Backwardation. So VIX trading mistakes, right? So you're holding VXX, UVXY long term. I don't know why you'll do that, but hey, this will destroy your position. Buying VIX, it's low because it's low. I don't understand. Again, that doesn't make sense. VIX can stay low for months while you decay. So yeah, shorting VIX without a stop. One spike can wipe you out. VIX from 20 to 80, as we've seen it here, is a 300% loss. But again, I don't know why. Well, let's keep going. And ignoring the term structure. Contango or backwardation matters more than the VIX spot. Well, this is going to be our last quiz. Then I have one more thing that I want to do with y'all before I finish this. I want to create a scanner that is able to pull in our historical data from VIX, right? That I already have collected for y'all. And this is VIX for the past 5 or 6 years from 2020 to 2025, right? And it's going to look at VIX live now. Then it's going to compare it, being able to see, okay, historically, if we're looking at VIX live now, is it good? Is it average? Is it something we should be looking at, right? This is something I want to create with y'all using Claude Code. So this will be our last lesson that we're going to do. Then we're going to jump straight into that. So VIX is at 12, very low. What is a reasonable strategy? Short VIX heavily? I wouldn't say heavily. Short VIX heavily, it can go up later, right? Buy cheap VIX calls as portfolio insurance. Load up on VXX, it's about to spike. Just by process of elimination, bruv, I want to go with B. Yeah, because all those other things is like, bro, why would I do that? Why would I do that? VIX spiked from 20 to 45 during a market crash. What now? Buy more. Okay. No. Consider mean reversion. VIX usually fades from extremes, usually, but not all the times, right? But again, if you're going to fade it, you got to know what the hell you do. Nothing. VIX doesn't matter during crashes. Just by process of elimination, we're going to go with B. All right, what's the number one mistake beginners make with VIX products? Trading it too frequently. That's good. Holding VXX UVXY long term. That's better, right? Decay. Not using enough leverage. I could just eliminate that. So it is going to be B. All right, Guopiter. So what we're going to do right now is we're going to open up Claude Code, and I'm already inside Cursor. I just want to make sure it doesn't, because what Claude Code like to do now is like to expose emails, right? And we don't want that. So what I want to do is make sure that I can run it and it doesn't expose the email, which is, all right, Guopiter. Beautiful, beautiful. So I'm Claude Code. We're going to be using the 4.6 Opus model, Opus, tomato at that point. And this is the model that just dropped, right? And just dropped on the 6th, that is, and today is February the 9th. So we're going to be using that model in order to create this VIX scanner, if you would, that's going to run in terminal. So I kind of already created one, but this is one that I created for SPY and QQQ. So we're going to be creating one for VIX that it's going to run, and whenever it runs, it can be able to gauge, all right, what is the market sentiment, what is the history over the past 6 years, right, and what is the typical pattern. So this is something I want us to be able to create for VIX so we can use it when we're trading our algo bots. So what I'm going to do, we already have the VIX data, which is here. So I want to do and say you are a senior Python developer with expertise in developing algo scanners. Review the following VIX data. I need to go give it the conda environment as well. Let's see if we can get this done under 10 minutes. I want to keep this video under an hour. So my fault. I got a little carried away. So let's finish this up. All right. I gave you the data. Run in using Python, not Python 3, and make sure you understand the VIX data before we proceed with this sprint. For the duration of this sprint, keep all of your responses under 328 total tokens for each output response, and make sure not to share any security or API keys. We are streaming on. Make sure not to share anything over logs. Review using Parquet tools to get the data before we proceed. All right, beautiful. Nice little prompt. Oh, market is closed, so I can close that out. So now we're going to do right now, Claude Code is going to go over the data, right? It's going to be running terminal commands. And terminal commands are like running scripts or manual scripts in order to understand the data a little bit more. So what it's doing right now, it's using the pandas library. Pandas is like the Excel for Python in order to understand the data. It's making a data frame, and then it's trying to find what is the open, high, low, the last, and then it's going to describe the months covered, and then it's going to sort it by the months, and it's going to make sure all of it is unique. So that's what it's doing right now. It's checking the data quality, and it wants to make sure that there's no null values, and it actually has information there. So go ahead and run it, and as you're going to see, there's no nulls. Nulls is just values that doesn't have anything. All right, beautiful, ready for sprint. No null values, beautiful. All right, we want to build a VIX scanner that is able to run via terminal and allows us to gauge the historical context of VIX versus real time. Basically, we want to know on Feb 9th, right, what is the 6-year, what has happened previously, and how does it compare to normally, and what it is now. Does that make sense? I know it is a bit not as collected, right? But let's clean this up and make sure you get what we're trying to do before we have you test how to get VIX live. And this is why I love being able to use the office models, right? I don't have to spell everything just about the same, and it still can get what I'm going to ask for, right? Another great thing about using AI, as long as you point it in the right direction and you can control what the hell it's doing, then we can be able to do it. So for any given date, February 9th, the scanner would load the historical day, pull all February 9th date across, okay? Show the average, how is, okay, normal baseline compared to the live, clean output. Right now, VIX is 1522. On this day, historically, it averaged 1844, range between 12 and 28. 80% of the time, it was higher than today. Current levels are suppressed versus the history. Okay. Should it also look for when? No. One, we want it to be the exact date. So we are going to be using this when we're trading our 0DTE bots, right? And want to be able to have this additional tool to use and to have the context needed for this. Does that make sense? And for VIX, see, and then should understand how to get it, then run a few C curls to check before we proceed. All right, what I also want to do is just show it one example. Got it. Trading error is the VIX source. Yes, it is. So get me right, fam. Perfect, perfect. All right, so it's able to do that. Okay, previous close, normal range, trading error already has VIX. Okay, for the scanner, we'll just reuse it. For the barrier tokens, perfect. All right, before we do it, see how we've done this with SPY and QQQ for another scanner, right? To get an understanding before we build this one out, and then gauge how this will be different and provide a visual of how this one will look and what it will carry and present to us. Beautiful, beautiful, beautiful. So we're having it go through our previous scanner, and that's the one that you just seen that I showed y'all. That was for SPY and QQQ. It did have some VIX data in there too. So again, just being able to reinforce what we're looking for before it actually creates the file for us. And then it's going to create the VIX file here. I just wish that these outputs could be a little bit quicker. I'm not going to hold you, or just a little bit better UX UI. Like, hey, I'm reading the data, or hey, I'm doing that. Beautiful. Okay, it's not Sunday. That's how I know. And this is supposed to be the latest model. Y'all see how it's tripping. Today's definitely Monday the 9th. Okay, VIX scanner, the range, historical context. Intraday patterns, 0 DTE context. VIX is below the, okay. All right, beautiful. All right, let's build it here. Let's make sure to call it VIX scanner .py. Proceed. Ensure to follow solid, OOP, dry, and SRP best practices when creating this file. No cache at all live, and make sure it has context of when the market is open and advises the user accordingly. If not, and advise when the next market open is. Now let's get this done. All right, about another 5 minutes or so, we're going to have our VIX scanner done, our VIX scanner created. And this is something that I've been looking to create for a while now. I'm kind of glad that I'm creating it here live with y'all so you can be able to see it. How did I get my VIX data? I got the VIX data from bar chart. I'm not going to hold you. There's a way to get it for free, but I just can't talk about it here. I got it from bar chart. So it slid, and then I turned those files. When you get from bar chart, right? Do I have an example? Let me see if I can show an example without like it's just showing my information. All right, I can't show y'all an example. Bet. Let's go over the bar chart. I'm just gonna make this stupid. All right, so what I want to do, how do I download the data, right? And I had to do it one at a time. So you imagine my chagrin when I had to go through this. So we're doing VIX, and then we're doing 1 minute data, and I had to do this month by month, fam. So we're going to do from the 1st through the 31st. Then we're going to hit download. Then you get 250 a day. So I was like, all right, that's what's up. Now let me go grab that so you can actually see that. Here's what it looks like, fam. Can you see that? So this is the VIX data for the entire month, right? So it gives us the date, the timestamp, the open, the high, low, and the close, the change, right? And it's minute by minute. Every 1 minute is giving us the file. So this is quite comprehensive, yeah. And I got this from bar chart, and I'm using that data in order to create this scanner. Let's make this a bit more regular. I mean, if you can't, you can get VIX for free from CBOE, but like it's not going to be as comprehensive. It's just going to give you an end of day snapshot. You still can do what I'm doing with CBOE end of day snapshot, but again, it's not going to be intraday. What is intraday? Being able to have the 1 minute data. So I can tell when I run this on, okay, tomorrow, for an example, when I'm paper trading, don't worry, I'm going to be paper trading live. Y'all are going to be able to see, all right, at 9:30 on February 10th, we have the 6 minute average, right, across all years, plus what VIX is open at. So we can be able to have historical context and also being able to work in live data, right? So that's why I love being able to create it that way. Well, that's why I like being able to get it from bar chart. So yes, you can still do it with CBOE, but again, it's just going to be end of day. So you have one snapshot instead of thousands of rows of snapshots, right? Let me actually open the file so y'all can see it and not just doing this like little. Okay, here it is. Let me actually zoom in so you can see it. How many rows of data do we have? We have damn near 16,000 rows of data, right? And if you were to just the end of day, it would have been 1, right? Whereas here we have 16,000 rows of data and it's still going. right? And it gives us this for the entire month, right? So every month, minute by minute, right? So you see, just for I'm just going to do just for January 2nd, how much data you're going to get just for January 2nd, as opposed to just the end of day snapshot. End of day snapshot is just one, right? But just for January 2nd from bar chart, let me show y'all how much. Damn, tired of scrolling at this point. Hold on, we're almost there. Almost there. All right, I'm tripping. All right, I got lost. It's fine. But y'all can see damn near 300 rows of data just from the second, right? I can appreciate that. So that's why I like to use bar chart as opposed to getting it free from CBOE. And how do you get it free from CBOE? Just being able to, and I'll drop that command in the description as well. So don't worry, I'll definitely have you covered. So right now I'm just waiting for Claude Code to be able to kick out this code. And as soon as it kicks it out, I can show you that it works. And then we're going to tie a bow on our VIX episode here. And I really am glad that y'all are tuning in. And if you do have any questions specifically, you can definitely let me know. If you're looking for anything specific, like if you want us to be able to break down, and don't worry, I have a couple of great episodes coming out for y'all, right? So just be on the lookout for that. But nonetheless, if you want something very specific, you can always let me know. Okay, I thought I was going to talk for like another 10 minutes. I mean, I could have. Would have been like, bruh, come on. All right, let's test it. Crapola. Hold on, I gotta get out that folder. I just realized what folder I was in. So CD to get out that folder, then CD to get back in the folder. And I need to go get the VIX scanner. Let's grab the VIX scanner. Let's go ahead and run it. Guapater, man. Let's go. The market is closed. Okay, live VIX from last known 1736. That will be confirmed that. Previous close 1776. Beautiful. Day range was 1690 to 9. VIX hit 19 today. Oh, I really would have been talking shit if I would have seen that. Average VIX from the 5 years on today. So it went to tomorrow, right? It's 1938, right? Today's range is 1550. Excuse me, today is 1536. The range is 1515 to 2471. This is in the 40th percentile, so this is normal, right? So we do have our scanner that we created. Don't worry, I'm going to polish this up a bit, so next time you see this, it's going to be a little bit better. But if you haven't already, I need you to go ahead and like and subscribe. It is your boy Creative. We'll be back at it again with another episode.